Every major brokerage firm has a list of recommended investments for retirees. I've seen these lists for 50 years. They're in every retirement planning book, taught in every financial advisor training program, and printed on glossy brochures in bank lobbies across America. And after watching what happened to retirees in 2008, 2020, and 2022, I can tell you with certainty, following this conventional wisdom has destroyed more retirement security than market crashes ever could. The financial services industry has a vested interest in keeping you invested in certain products, not because they're best for you, but because they're most profitable for the firms selling them. I'm not talking about conspiracy theories or hidden fees, though those exist. I'm talking about something more fundamental. A misalignment between what Wall Street needs to sell and what you need to own after 60. Here's what the data actually shows. Between 2000 and 2022, retirees who followed standard Wall Street advice experienced three separate periods where their portfolios declined by more than 30%. 3 times in 22 years. If you're 65 and your portfolio drops 30%, you're not riding it out until the next cycle. You're making permanent decisions about your lifestyle, your health care, your ability to help your family. The math doesn't work the same way it did when you were 40. I've spent 5 decades studying what actually preserves wealth through market cycles. Not what sounds good in a presentation, not what generates commissions, what actually works when the pendulum swings. And I'm going to show you 7 investments that Wall Street actively promotes to retirees that you should avoid. Not because they're always bad investments, but because they're wrong investments for where you are in life and where we are in the cycle. Let me prove it to you with numbers, not opinions. Before I continue, I need to know something. What's currently the largest single investment in your portfolio outside your home? Just drop it in the comments. Don't worry about percentages or dollar amounts. I just want to see what people over 60 are actually holding, because I suspect many of you are sitting on exactly the investments I'm about to discuss. And if you're serious about protecting what you've spent a lifetime building, subscribe now. This channel isn't about chasing returns or finding the next hot stock. It's about second-level thinking, the kind of thinking that asks not, what can I make, but what can I afford to lose? That's the question that matters after 60, and it's the question Wall Street doesn't want you asking. Now here's what I'm going to show you. 7 specific investments that financial advisors regularly recommend to retirees, why they're more dangerous than they appear, and what you should be thinking about instead. But you have to stay until the end, because the 7th investment is the one I see most often, and it's the one that concerns me most right now given where we are in the cycle. Let me start with what most people get wrong about investing after 60. They think the goal is still growth. They've been conditioned for 40 years to measure success by annual returns, to compare their portfolio performance to the S&P 500, to feel like they're missing out if they're not fully invested in risk assets. Every financial advisor tells them they need growth to fund a 30-year retirement. Every retirement calculator assumes 7% annual returns. Every investment seminar promises strategies to make your money last. But here's what 5 decades of watching market cycles actually shows. After 60, the goal isn't growth, it's permanence. Not maximizing returns, but minimizing the probability of a permanent loss of capital that forces you to change how you live. This isn't opinion. This isn't conservative bias. This is mathematics. When you're accumulating wealth, volatility is your friend. A 30% decline at age 40 is a buying opportunity. You have decades of earnings ahead, decades of contributions, decades to recover. But a 30% decline at age 65 is a crisis. You're withdrawing, not contributing. You're selling into weakness, not buying it. The sequence of returns matters more than the average return, and conventional financial planning completely ignores this. And it all comes down to asymmetric risk. Not balanced portfolios or diversification, but understanding that the downside matters more than the upside when you can't afford to start over. I'm going to break this down into 7 specific investments you should avoid. Each one is commonly recommended. Each one sounds reasonable. Each one has destroyed retirement security for people who trusted conventional wisdom, missed the reasoning behind even one, and you might make a mistake you can't recover from. Understand all 7, and you'll see the financial services industry differently. Let's start with the investment that sounds most conservative, but might be most dangerous. Investment-grade corporate bonds with durations over 10 years. Every retiree owns these. They're called safe because they're investment grade. They're called income because they pay regular coupons. They're in every target date fund, every balanced portfolio, every retirement allocation model. And they've been one of the worst investments for retirees over the past 3 years. Here's what most people don't understand about bonds. They have two risks, not one. Credit risk, which everyone focuses on, and duration risk, which almost nobody understands until it's too late. Investment-grade bonds have minimal credit risk, but long-duration bonds have enormous interest rate risk, and we just experienced the fastest rate increase in 40 years. In 2022, the aggregate bond index fell 18%. 18%. This was supposed to be the safe part of your portfolio. This was supposed to be the ballast when stocks declined. Instead, it fell almost as much as stocks did. Retirees who thought they were being conservative by holding 60% bonds watched their entire portfolio crater. I see this constantly. Someone comes to me with a portfolio that's 40% long-duration corporate bonds. They bought them for safety and income. They have no idea that a 2% increase in interest rates causes a 20% decline in a bond with 10-year duration. They don't understand that their safe investment has equity-like volatility when rates move. Every time we're in a rising rate environment, people make this exact mistake. And every time they're shocked by the outcome. Let me show you this principle in action. In 2021, long-duration investment-grade bonds yielded around 2%. Seemed safe? Seemed stable? Seemed appropriate for retirees? Everyone believed rates would stay low forever. The Fed said rates would stay low. Every economist predicted low rates. Advisors built entire retirement plans around low rates. Then inflation appeared. Rates rose from 0 to 5% in 18 months. Those bonds that yielded 2% and seemed safe, they lost 30 to 40% of their value. 30 to 40% in the safe part of the portfolio. Retirees who needed to sell to fund living expenses locked in permanent losses. Retirees who held on missed years of higher yields available in new bonds. The investors who understood duration risk stayed short or stayed in cash during 2021. They accepted 2% yields and criticism for being too conservative. They watched others chase an extra 50 basis points in long-duration bonds. Then, when rates rose, they had dry powder to buy bonds at 5% yields while others were sitting on unrealized losses. This wasn't luck. This was understanding that duration risk matters more than yield when you can't afford permanent losses. At Oaktree, we've always been cautious about duration in client portfolios, especially for those who can't afford volatility. When rates were at historic lows in 2020 to 2021, we kept durations short despite criticism that we were leaving yield on the table. Our investors questioned us. Why hold 2% bonds when you could get 3% by extending duration? Because we understood that the risk of rising rates was asymmetric. The extra 1% yield didn't compensate for the potential 20% loss if rates normalized. The outcome validated our caution. When rates rose, portfolios with short duration held their value and could be reinvested at higher yields. Portfolios with long duration experienced the worst bond market in generations, not because we're smarter, because we respected duration risk and understood where we were in the cycle. Now here's the second-level thinking. First-level thinking says long-duration bonds are safe because they're investment grade. Second-level thinking asks what happens if the thing everyone believes, that rates will stay low forever, turns out to be wrong. And when you ask that question, you realize that consensus beliefs about rates create the most dangerous environment for duration risk. So what do you actually do? Keep bond duration under 5 years, preferably under 3. Accept lower yields in exchange for lower volatility and faster reinvestment opportunity. Consider treasury bonds instead of corporate if you're holding for safety rather than yield. This isn't complicated, but it requires accepting that you might earn less in a continued low-rate environment. Most people can't accept that trade-off. That's why most people experienced devastating bond losses in 2022. But long-duration bonds aren't the most dangerous investment I see in retirement portfolios, because at least bonds eventually mature at par if you can hold them. The next investment I see constantly never recovers from a decline, and retirees keep buying it because it sounds perfect for income. High dividend stocks in declining industries, telecommunications companies yielding 7%, tobacco companies yielding 8%, retail REITs yielding 9%. They're in every dividend aristocrat list, every high-income portfolio, every retirement income strategy, and they're value traps that permanently destroy capital while paying you a dividend to watch it happen. Here's the fatal mistake, confusing yield with return. A stock that pays an 8% dividend but declines 10% annually in price gives you negative 2% returns. You're collecting income while your capital erodes. And once you're over 60, and withdrawing that income to live on, you never recover. The dividend isn't return, it's just return of your own capital in installments. I've watched this destroy retirement security repeatedly. Someone retires with a portfolio of high dividend stocks, telecommunications companies, utilities, tobacco, retail, REITs. They yield 6 to 9%. Seems perfect. They can live on the dividends without selling shares. Sounds like a perpetual income machine. Except the share prices decline every year, the business models are deteriorating, the dividends eventually get cut, and after 10 years, they've collected income while losing 40% of their capital. This happened with AT&T, yielded 6 to 7% for years. Retirees loved it. Steady dividend, established company, essential service. Then the business model deteriorated under competition and debt. Share price fell from $40 to $15 over a decade. Dividend eventually cut in half. Retirees who bought for income and held for safety watched 70% of their capital disappear while collecting dividends that didn't compensate for the capital loss. The investors who understood this avoided the yield trap. They recognized that a high yield often signals market concern about sustainability. They asked why the yield was high, not because the dividend was generous, but because the share price had fallen due to business deterioration. They understood that in declining industries, today's dividend comes at the expense of tomorrow's capital. This is what I meant in The Most Important Thing when I discussed the importance of understanding what you own. A high dividend isn't free money. It's either a return on invested capital if the business is healthy, or a return of invested capital if the business is declining. After 60, you can't afford to confuse the two. So what do you actually do? Avoid high-yield stocks in declining industries, no matter how attractive the dividend appears. If a dividend yield is more than 2 percentage points above the market average, ask why. Usually the answer is business deterioration or unsustainable payout ratios. Neither is appropriate for capital you can't afford to lose. Focus on dividend growth rather than dividend yield. A 3% yield growing at 7% annually is better than a 7% yield declining to 4% over time. This leads to an important question. If high-yield stocks are dangerous and long-duration bonds are volatile, what about the investment that combines both problems? Preferred stocks. I see these in almost every retirement portfolio I review. They're marketed as bond-like stocks or stock-like bonds. They pay high dividends, usually 5 to 7%. They're issued by banks and utilities and insurance companies. They seem perfect for retirees who want income. And they combine the worst characteristics of both stocks and bonds with the benefits of neither. Here's what makes preferreds so dangerous. They have the interest rate sensitivity of long-duration bonds, the volatility of stocks, no maturity date, and subordinated claims in bankruptcy. When interest rates rise, they fall like bonds. When the issuing company has problems, they fall like stocks. When markets get volatile, they fall like both. And unlike bonds, they don't mature. Unlike stocks, they don't participate in company growth. You get the risks of both asset classes with the benefits of neither. The evidence for this principle is overwhelming. In 2022, when both stocks and bonds fell, preferreds got demolished. The preferred stock index fell 25%, not because of credit problems, because of interest rate risk combined with equity volatility. Retirees who thought they were getting safe income watched a quarter of their capital disappear. And unlike bonds, there's no maturity date where you get your principal back. The loss is permanent unless the preferred recovers, which can take years or never happen. I've written extensively about this in my memos. The importance of understanding what you own and what risks you're actually taking. Preferreds are marketed as conservative income investments. But the risk profile is aggressive. High duration, no maturity, subordinated claims, call provisions that benefit the issuer, not the holder. After 60, you need to understand that marketing language and actual risk are often opposites. At Oaktree, we generally avoid preferreds in portfolios for people who need capital preservation. The yield doesn't compensate for the combination of risks. If you want fixed income, buy bonds with reasonable duration and maturity dates. If you want equity exposure, buy common stocks with growth potential. Don't buy a hybrid that gives you the worst of both. Now here's the second-level thinking. First-level thinking says preferreds are conservative because they pay steady dividends and are issued by stable companies. Second-level thinking asks what happens in a rising rate environment or a credit stress scenario. And when you ask that question, you realize you're taking bond-like duration risk, equity-like volatility, and subordinated credit risk, all for a few extra percentage points of yield. So what do you actually do? Avoid preferreds entirely unless you're an institutional investor with specific tax or regulatory reasons to own them. If you want income, build a ladder of short to intermediate term bonds. If you want equity exposure, buy quality common stocks. Don't own a security that combines multiple risks without compensating benefits. But preferreds aren't the investment that concerns me most right now, because at least preferreds are a known risk category that sophisticated investors avoid. The next investment I'm going to discuss is in almost every retirement portfolio, recommended by almost every advisor, and it's more dangerous today than it's been in 15 years. Target date funds set for your retirement year or past. You're 65, so you own a 2025 or 2030 target date fund. Seems logical, seems automatic, seems like exactly what you should own. And it's a one-size-fits-all product that doesn't fit anyone, rebalances at exactly the wrong times, and charges fees for doing what you could do better yourself. Here's the problem with target date funds. They follow a predetermined glide path regardless of market conditions. They automatically shift from stocks to bonds as you age. Sounds good, except they make these shifts based on your age, not based on where we are in the market cycle. They sold stocks and bought bonds throughout 2020 to 2021 when stocks were expensive and bonds yielded nothing. They're mechanical, not thoughtful. They're calendar-driven, not cycle-driven. The data on this is shocking. Target date funds for people retiring in 2022 held 60% bonds going into that year. Bonds then had their worst year in history, falling 18%. The safe allocation designed to protect near retirees failed completely because it was based on age, not on the reality that bonds at zero yields have enormous downside risk. I see this constantly. Someone has their entire 401k in a target date fund. They think it's being professionally managed. They think someone is making thoughtful decisions, but it's just an algorithm following a predetermined path. When stocks are expensive, it keeps buying stocks because that's what the glide path says. When bonds yield nothing, it keeps buying bonds because that's what the age-based allocation requires. It's not investing, it's just automatic rebalancing without regard to value or cycle position. Let me show you this principle in action. In 2008, target date 2010 funds designed for people retiring in 2 years held 50 to 60% stocks. The market crashed. People retiring in 2010 watched their portfolios fall 30 to 40%, right when they needed the money. The glide path said hold stocks, so they held stocks, regardless of valuation or cycle position. The investors who understood this didn't use target date funds. They made allocation decisions based on where we were in the cycle, not where they were in their age. In 2007, when stocks were expensive, they shifted to cash and short-term bonds, regardless of their age. In 2009, when stocks were cheap, they bought regardless of being too old for equity exposure. They understood that cycle position matters more than age-based formulas. This is second-level thinking in action. First-level thinking says, target date funds are perfect because they automatically adjust for your age. Second-level thinking asks whether age-based allocation makes sense when it ignores market valuation and cycle position. And when you ask that question, you realize you're paying fees for mechanical rebalancing that often does exactly the wrong thing at the wrong time. So what do you actually do? Avoid target date funds entirely if you're capable of making basic allocation decisions yourself. Build your own portfolio with awareness of where we are in the cycle. Hold more cash when assets are expensive. Buy more risk assets when they're cheap. Don't let an algorithm make decisions that should be based on cycle awareness, not birth year. This principle works, but only if you're willing to accept that your allocation might look different from people your same age. Most people can't accept that. They want the comfort of following a standard formula. That's why most people get standard results. Now I'm going to show you something that will surprise you, because the next two investments I'm going to discuss aren't obscure products or complex derivatives. They're investments that everyone owns, everyone recommends, and everyone assumes are essential for retirement. But in the current environment, they're more dangerous than they've been in decades. Investment number 6. Broad market index funds when markets are expensive. You own VOO, or SPY, or VTI. You've been told for 40 years that index funds are the smart, low-cost way to invest. You've read the studies showing active management underperforms. You've heard Warren Buffett recommend index funds. And everything you've been told is correct, except for one critical detail. It matters what price you pay. Here's what people miss about index funds. They're not inherently safe or smart. They're just a delivery mechanism. An index fund at a CAPE ratio of 15 is different from an index fund at a CAPE ratio of 35. Same fund, different risk. And right now, we're closer to 35 than 15. That means below average forward returns and above average downside risk. The evidence is clear. When the S&P 500 CAPE ratio exceeds 30, the subsequent 10-year returns average around 3 to 4% annually. When you're over 60 and withdrawing 4% annually to live on, 3% returns mean you're depleting capital. Add inflation, and you're going backwards in real terms. The math doesn't work. But everyone keeps buying index funds because that's what they've been told to do for 40 years. I've watched this pattern repeatedly. Markets get expensive. Valuations reach extremes. Everyone knows it's expensive. But everyone keeps buying index funds because you can't time the market and stay invested for the long term. Then, markets correct. Retirees who kept buying at high valuations experience losses they can't recover from because they're withdrawing, not accumulating. At Oaktree, our entire investment approach is built on buying when others are selling and selling when others are buying. Not because we can time the market perfectly, but because we understand that paying attention to valuation and cycle position improves outcomes. In 2021, when markets were expensive and everyone was fully invested, we raised cash. We accepted criticism for missing further gains, but we understood that forward returns from high valuations are poor and risk of significant declines is high. This is what separates institutional thinking from retail behavior. Institutions adjust exposure based on opportunity set. Retail investors follow rules like always stay invested, regardless of valuation. After 60, you can't afford to follow rules that ignore cycle position. So, what do you actually do? Reduce index fund exposure when valuations are expensive. Hold more cash, wait for better opportunities, accept that you might miss some upside if markets continue higher, but protect against the downside that becomes more probable at high valuations. This requires discipline most people don't have. That's why most people experience full market declines when they can least afford them. This brings us to the seventh investment, and this is the one that concerns me most because it's the most common and the most misunderstood. Annuities sold as retirement income solutions. Variable annuities, indexed annuities, fixed annuities with income riders. They're in every retirement seminar, every insurance agent's presentation, every guaranteed income strategy. They promise security, income, and downside protection. And they're some of the most expensive, complex, and misunderstood products in financial services, with fees and restrictions that devastate long-term wealth. Here's the reality about annuities. They're insurance products sold by commission-driven salespeople, not investments chosen by fiduciaries acting in your best interest. The fees are often 3 to 4% annually when you add up all the layers. The restrictions on access to your money can last a decade or more. The guarantees come with so many conditions and limitations that they rarely work as advertised. And the insurance company keeps the money when you die, so you're not building legacy wealth. I've seen this destroy more retirement security than any other single product. Someone buys a variable annuity at age 65. They're told it guarantees lifetime income. They put $300,000 into it. The fees are 4% annually. Over 20 years, they pay $240,000 in fees. The market returns 6%, but they net 2% after fees. They could have built a simple portfolio of bonds and dividend stocks, paid minimal fees, maintained control of their capital, and had money to leave their family. Instead, they paid $250,000 in fees for guarantees they could have created themselves. This isn't opinion, this is mathematics. Annuity fees compound against you the same way investment returns compound for you. A 4% annual fee on a $300,000 investment costs $12,000 the first year. If that $12,000 was invested instead of paid in fees, it would compound over time. Over 20 years, those fees and lost compounding opportunity represent more than $500,000 of wealth transferred from you to the insurance company. The evidence for this principle is overwhelming. Academic studies consistently show that annuity buyers would be better off creating their own income portfolios with bonds, dividend stocks, and systematic withdrawal strategies. The fees, restrictions, and opportunity costs of annuities exceed any value from the guarantees. But annuities are sold, not bought. Salespeople earn 10% commissions. They have every incentive to make them sound essential. I've written extensively about this, the importance of understanding what you're paying for and whether the cost is justified. Annuities are marketed as providing peace of mind, but peace of mind that costs 4% annually and eliminates flexibility and legacy wealth isn't peace of mind. It's expensive false security. Now here's the second level thinking. First level thinking says annuities provide guaranteed income, which sounds perfect for retirement. Second level thinking asks what you're paying for that guarantee, what restrictions come with it, what alternatives exist, and whether the guarantee is worth the cost. And when you ask those questions, you realize that you're paying enormous fees for something you could create yourself while maintaining control and flexibility. So what do you actually do? Avoid annuities entirely unless you have a specific need that can't be met any other way, and even then, only use the simplest, lowest cost versions. Build your own income portfolio with short-term bonds, dividend-growing stocks, and systematic withdrawal strategies. Maintain control of your capital, minimize fees, preserve flexibility, keep the ability to leave wealth to your family. This requires more work than buying an annuity, but it preserves hundreds of thousands of dollars over a retirement. That's where we started. Wall Street hiding the truth about investments they want you to buy. Now you understand why these 7 investments are wrong for you after 60. Avoiding these 7 investments isn't about being conservative or missing opportunities. It's about understanding asymmetric risk, about recognizing that after 60, the downside matters more than the upside, about accepting that Wall Street's interests and your interests aren't aligned. I've spent 50 years learning this. I've made mistakes with every one of these investment types. I've watched market cycles destroy people who followed conventional wisdom, and I've distilled it down to one principle. After 60, your job isn't to maximize returns. It's to minimize the probability of outcomes that force you to change how you live. You now know what took me decades to learn. You have an advantage. The question is, will you use it? Because here's the reality. Most people will read this, nod along, and change nothing. They'll keep their target date fund because it's automatic. They'll keep their high dividend stocks because they like the income. They'll keep their long duration bonds because they're called investment grade. They'll make the same mistakes. They'll get the same results. Don't be most people. Go look at your portfolio right now. Identify which of these 7 investments you own. Write down the specific positions. That's your first step. Then over the next 30 days, systematically replace them with simpler, lower cost, lower risk alternatives that give you control and flexibility. And subscribe if you haven't already. Because understanding what to avoid is just the beginning. You also need to understand what to own, how to position for different market environments, and how to think about risk when you can't afford to start over. This is about second-level thinking, about cycle awareness, about defensive investing that actually defends. Markets swing like a pendulum. Right now, we're not at the extremes, but we're not in the safe middle either. Valuations are elevated, rate volatility is high, cycle position is uncertain. This is exactly when you need to avoid the investments that seem safe but carry hidden risks. That's what 5 decades of investing teaches you. That's what surviving multiple market cycles shows you. That's what building Oaktree Capital Management proves. Avoiding these 7 investments is possible, but only if you're willing to think differently than the crowd, ignore conventional wisdom when it's wrong, and accept that safety sometimes means accepting lower returns in exchange for avoiding permanent losses. I can't do it for you. I can only show you what to avoid and why. The rest is up to you.